All right, let's get right into it. Today, we're breaking down Waystar's Q2 earnings, and wow, what a quarter. They really delivered, so let's jump straight into the numbers that have everyone talking.
So what's the headline here? It's simple, really. A clean beat and a solid raise. This is actually their fifth straight quarter of double-digit growth, so you can see why management is feeling pretty confident about their outlook.
So let's talk numbers. On the bottom line, we're looking at non-GAAP earnings per share of 36 cents. That just blew past what analysts were expecting. They were penciling in 33 cents. A solid beat, no question.
And the top line? Just as good. Revenue came in at over $270 million. Now, to put that in perspective, that's about $14 million above the high end of what Wall Street was looking for. And you've still got that really healthy 15% year-over-year growth. Nice.
Okay, so here's how we're going to break this all down for you. We'll kick things off with a quick snapshot of the quarter, then dive into the AI Everywhere engine that's really powering things. After that, we'll look at the big Iodine acquisition, unpack the new guidance, and finally, we'll wrap up with our take and some potential trade ideas. All right, first up, the Q2 snapshot. And really, the theme here is just strong execution across the board.
Okay, let's unpack these numbers, because this is where it gets really interesting. Yeah, the 15% revenue growth is great, but they're doing it with higher margins. But for me, the number that just jumps off the page is that 115% net revenue retention. Think about that for a second. That means their existing customers are spending 15% more this year than last year. That's sticky. It tells you they're building a platform their clients just can't quit.
So how did the market take all this? Pretty well, actually. You see that little pop in after hours? Well, that momentum just kept going into the next day, closing up over 3.6%. And check out that volume spike. We're talking over 4.4 million shares traded. That's not just noise, that's big money taking notice.
So, you're probably wondering, what's actually driving these numbers? What's the why behind the beat? Well, if you listen to the earnings call, management made it crystal clear. It all boils down to their AI Everywhere strategy. And the key thing is, it's not just talk, it's delivering tangible results.
And this quote from CEO Matt Hawkins really says it all. This isn't just about making things a little bit faster or a little bit better. No, they're talking about completely changing the game, creating a claim that is so perfect, so undeniable, it just sails through the system. That's the moonshot they're aiming for.
And if you want proof that they're making progress, look no further than this number. $6 billion. That's how much in denied claims their AI platform has already prevented, and that's just in the first half of this year. We're talking about a massive direct return on investment for their clients.
And get this, they're already pushing into the next frontier with generative AI. Their new tool, Altitude AI, is delivering a 70% productivity boost for the whole claims appeal process. Let me put that in perspective for you. For a regular mid-sized hospital, that's like getting almost 10 extra full-time employees for free. It's a total game changer.
And this AI impact, it's not just isolated to one little corner of the business. I mean, look at this. It's finding the right insurance for claims that would have been complete write-offs. It's boosting how much cash they collect from patients by over 20%. And it's even speeding up how fast they get paid. It's hitting every single part of the revenue cycle.
Okay, so they're firing on all cylinders with the core business, but that's not the whole story this quarter, not by a long shot. They're making a huge bet, a major strategic pivot with the acquisition of Iodine Software. This is them moving upstream, from the back office finance stuff right into clinical intelligence.
Now, before we get into the nitty-gritty, there's one word you're going to hear a lot: accretive. All it means is that the deal makes the company's financials look better right away. And Waystar is saying this Iodine deal is going to be accretive to their margins from day one. That's a big deal. It means it's a financially healthy move right out of the gate.
And this chart right here, this tells you exactly why they're so excited. Look at Iodine's numbers. They're bringing about $122 million in revenue, sure, but look at those margins. A 75% gross margin, a 40% EBITDA margin. I mean, it's a beautiful, high-quality business that fits perfectly with Waystar's own financial profile.
So what's the big idea behind this deal? Well, it really boils down to four key things. One, it makes their total addressable market, the pie they can go after, more than 15% bigger. Two, it's like a time machine, accelerating their product roadmap by a full 2 years. Three, they think they can squeeze out over $15 million in cost savings or synergies. And four, and this might be the biggest one, it opens up a ton of cross-selling opportunities.
All right, so that's the what and the why of the quarter. Now let's turn to the future. What does management expect next? They did raise their guidance, which is great, but there's a little bit of a catch, a caveat, if you will, that you really need to get your head around.
So first things first, the good news. They bumped up their full-year forecast. Revenue guidance is up by about $22 million, a 2% lift. And adjusted EBITDA guidance is up $12 million, a 3% lift. This is them basically saying, yeah, Q2 was great, and we feel good about the rest of the year. But here's the puzzle piece that had a lot of analysts scratching their heads on the call. If everything's going so well, why does their own guidance imply that the second half of the year will actually bring in less revenue per quarter than they just did in Q2? It seems weird, right?
Well, the answer is pretty straightforward. Seasonality. See that slice? About 30% of their business comes from patient payments. And that part of the business always has a stronger first half. Why? Because that's when people are still paying off their deductibles. Once they hit their out-of-pocket max, those payments drop off. It's a predictable rhythm of their business.
Okay, let's bring it all home. We've looked at the quarter, the AI engine, the big acquisition, and the guidance. So what does it all mean? This is our final section, the next call, where we give you our rating and a couple of ways to think about the stock.
So, when we put it all together, the clean beaten raise, the very strategic Iodine acquisition, and just the rock-solid execution, we're initiating coverage with an outperform rating. We just think this company is in a fantastic position to keep taking market share.
With that in mind, we've got a two-pronged trade idea for you. It's really two different ways to play this, depending on your time frame. There's the long-term, buy and hold the story play, and then there's a more tactical, short-term move. Okay, idea number one is for the long-term bulls. If you really believe in this AI everywhere story and the Iodine integration, this is for you. We're looking at something like a long-dated call option, or a leap. The idea is to give yourself plenty of time, say 18 to 24 months, for this whole story to play out and really drive the stock higher. It's a leveraged bet on that long-term vision. Now, idea number two is for the more tactical trader. The thinking here is that between now and when the Iodine deal officially closes at the end of the year, the stock might not do a whole lot. It might just trade in a range. So you could use a strategy like an iron condor to basically get paid to wait, collecting premium by betting the stock stays between two specific prices. It's a play on stability.
So we'll leave you with this one big question. Is Waystar making the leap? Are they successfully transforming from just another company that manages billing into the single, go-to AI platform for the entire healthcare journey, from the clinic all the way to the cash? That's the real question. And based on this quarter, the early signs look incredibly strong.
And of course, just a quick reminder, this is not financial advice. You should always do your own research.